Welcome students. So we are discussing the preparation of balance sheet, and in my previous lecture I shared certain important points with you regarding the balance sheet. So here we have completed the capital side or the liability side of the balance sheet, and we have shown here that what are the different sources from where the funds have been generated by the company, and then we have found out these are the three important sources. One is capital. After adjusting capital in terms of interest, drawings, everything and profit, we have found out the balance of capital is 1,06,558, then is the sundry creditors 12,170, and the apprentice premium advance income, that is 400, which is a liability, and sundry creditors are suppliers credit which the firm has to pay at the later date, and till that point time they pay it to the suppliers, it is shown as a liability. So it is 12,170. Now we come to the asset side of the balance sheet, and let us put the assets here. Here I would say that when we prepare the balance sheet, the items in the balance sheet should be put in the either of the two ways. One is either it should be in the order of permanence or it should be in the order of liquidity. Permanence means, when you talk about the permanence, when you talk about the liability side, the permanence means the long term sources should be put on the top and the short term sources should be put at the lower part. Similarly, when you talk about the asset side of the balance sheet, the long term assets, fixed assets should be put on the top, and then the short term assets should be put on the lower side. Long term assets means land, buildings, plant, machinery, furniture, which is going to stay with the firm for the longer duration. They should be put on the first, and then the current assets like your cash, inventory, sundry debtors, they should come on the lower part. Similarly, when you talk about the sources side, here you start with the capital. Capital is the longest source. Capital is coming on the first day and it is going to be returned when the firm is going to be dissolved or closed down, last day of the life of the firm. So it means longest source, then you are coming down to the shortest source. And then you talk about the assets, you take the longest asset is land, permanent asset, buildings, plant, machinery, furniture. They are going to be removed from the firm when the firm is going to be dissolved, closed down, and till that it is not removed, it is going to stay with the firm. So now we are starting the preparation of the balance sheet and putting the things on the asset side of the balance sheet. So what are the important assets here? We talk about first asset is, we have now you again start checking all the items here. Drawings we have already taken, it means now it is closed. Next thing is land and building. I told you it is asset, and asset, first asset, permanent asset will come here. First of all, it is land and building. No to no buy, land and buildings. Now you check before putting the item here that whether it has any depreciation amount or not. So if you talk about the, yes, it is a depreciation amount, it has the adjustment here. So it means one part of this adjustment we have already put in the profit and loss account. We have shown this in the profit and loss account, 2.5% depreciation we have charged, and that depreciation amount worked out was say 625 on 25,000 rupees, 2.5% is 625 rupees. We have shown there, one effect is there in the profit and loss account, we have shown the depreciation on the land and building. Second effect will come in the balance sheet, and the land and building here is 25,000. So put it in the inner column, it is 25,000, put it in the inner column, and then less depreciation, and then depreciation is 625, you subtract it. So you are left with how much? 25,275. This is the balance of the land and building now. This is 375, this is 375, 25,375 is the balance of land and building after depreciation, right. Second is plant and machinery, plant and machinery, and plant and machinery is 14,270, put it in the inner column because the depreciation is also there, 14,270. So, and less depreciation on this, and this was 10%. So, depreciation amount was 1427. So, you subtract it. If you subtract this, this works out as 12,843. 12,843 is the plant and machinery. Then we have furniture and fixtures. Furniture and fixtures. The amount is how much? Furniture and fixtures, the amount is 1250 less depreciation, and this is 125. So, we are left with the balance left is 1125, and this way the balance sheet is these three long term permanent assets are here with us. Then we have, now you again check it up. Carriage inward we have already taken, no need to take it again, right. Then we talk about the wages we have already taken, salaries we have already taken, sales return we have taken, bank charges we have taken, coal, gas and water we have already taken, rates and taxes we have taken, purchases we have taken, bills receivables. Now yes, we will talk about the bills receivable. Now we are talking about the medium term assets. They are, bills receivables are medium term assets. Bills receivables. I will discuss again what is the bills. I have already talked to you bills receivables, but again I will talk to you, but let us first complete the balance sheet and then I will discuss some of these items. Bills receivables, and bills receivables amount is 1270, no adjustment, nothing. So, straightway it will go to the outer column. Then we have trade expenses we have already taken, as you know, this is already done. So, it means now we have sundry debtors. Yes, now we have the sundry debtors. Sundry debtors. Sundry debtors amount is how much? 37,800. Put it in the inner column because there is adjustment pertaining to the sundry debtors. So, sundry debtors amount we have taken in the profit and loss account, and we have shown here the sundry debtors balance here. Provision for 5% on sundry debtors. So, it is 5% on sundry debtors we have made the provision, and that amount we have already worked out is somewhere here, that is a provision for sundry debtors is 1890. This provision was 1890. So, we have to subtract it because your sundry debtors have come down by this or may come down by this. So, this is the sundry debtors, and finally this amount will be 35910, means total credit sales are 37,800. Out of that 1890 sales may not be recovered, they are doubtful debts. Total debts are 37,800 and worth 1890 sales may not be recovered. So, finally we are treating that yes, we will be receiving only 35,910, not more than that we will be receiving in any case. So, it means we are sure about that we are not going to receive more than that. So, it is sundry debtors, final figure is 35,910. Then we have to take the other items here. Now we think about, we have taken the stock, we have taken the fire insurance, we have taken, now we will take the cash. Yes, cash at bank, cash at bank, cash at bank, and second is cash in hand. Cash in hand and cash at bank. Cash at bank is 13,000. No adjustments, so directly this amount will come here, and here it is cash in hand 850. Cash in hand is 850. So, this is, we have taken so far these assets. So, we have taken the land and building, amount is 25,000. Oh sorry, this is 24,000. This is not 25,000. We'll make the correction. 24,375. Then it is plant and machinery 12,843. Then it is the furniture and fixtures 1125. Then it is bills receivables 1270. Then it is sundry debtors 35,910. Cash is 13,000. That is cash at bank. Cash in hand is 850. And then one more item is here. Now you say check this side, this information also you can check. Depreciation we have taken on land and building, done. Plant and machinery, done. Furniture and fixtures, done. And make a provision of 5% on sundry debtors, done there. Then carry forward the unexpired amount of fire insurance 125 we have already taken. Rates and no, we have not taken, we have taken the one effect of this, but we will take the second effect of it. Rates and taxes will take the second effect of it. Apprentice premium we have taken already, the second effect also we have shown here, it means done. Interest on capital we have done both the effects. One effect we have shown in the profit and loss account, we have shown it as a debit entry there, we have taken out the money from profit and loss account and we have added this amount here in the capital, so both the effects are complete. Then we talk about the interest on drawings. Yes, we have already done. We have shown interest on drawing as a income in the profit and loss account 300 rupees, and the second effect of the drawings is coming here. We are adding it in the total amount of drawings. So total amount of drawings becomes 6780, and this total, both this plus this is subtracted from the capital. So finally we are left with the balance of 106558, which is the balance of the capital, amount of the capital. Now we have taken almost all the items here, but certain adjustments, double effect is left out. It means what is left out here is, say for example, carry forward the unexpired amount of the fire insurance 125. It means carry forward. We have paid 125 rupees in advance. It means expenses paid in advance. We have discussed one adjustment, that expenses paid in advance, as incomes received in advance is a liability. So what will be the expenses paid in advance? Asset. It means any expense which we have already paid, but that was not due to be paid in this particular year for this company. It means we have paid in advance, and any expense paid in advance is considered as, first is we subtract, first effect we have shown, we have subtracted this 125 rupees from the fire insurance. Where is the fire insurance amount? Fire insurance amount is given here. This is the fire insurance amount 490 rupees. So if you remember, if you check your profit and loss account, in the debit side, in the expense side, we have subtracted this from 490 rupees 125. So we have shown there 365 rupees. And now second effect of this particular part, not this part will be in the balance sheet, it will be shown as an asset. So it is advance fire insurance, advance fire insurance, you can write premium also because we pay the premium. Fire insurance premium paid in advance is 125, so this is the asset till to the extent of 125. Then it is the rate and taxes, they are also paid in advance. Advance rates and taxes, advance rates and taxes. So advance rates and taxes are 240 rupees we have paid in advance. 240 rupees rates and taxes we have paid in advance. It means that has to be treated as an asset. Now if you check almost all the items we have taken here, this total and this total information we have taken into account, and we have shown it, we have considered it in the balance sheet. Now we will total it up. Let us see whether it is equal or not. So now you total it up, it is 8, it is 7 and 5, 12, 2, 1, then it is 6, this is 1 and we are left with 1, 7 to 9. So it is going to be how much? 9, this is going to be 1 and this is going to be 1. 1,19,128, the total of capital side or capital plus liability side. It means we have raised this much of the total resources, 1,19,128. Now let us total the asset side also. We have forgotten this particular item that is given to us is closing stock. Closing stock has again the double effect. One effect is in the trading account, credit side we have already done. Second effect is in the balance sheet. So we have not taken the closing stock here. Yeah, we have not taken the closing stock here. So let us take the closing stock. Closing stock and this is 29,390. This is the closing stock. 29,390 is the closing stock. We have already taken here. 5, 8, 5. It is 13, 13 and 5, 18, 8, 1, 8, 12, 14. Then it is 21, 22, 27, 29, 33 and 9, 42. It is again 2. Then it is going to be total, if you make out, I think this is going to be 119 and 128. So both the sides are equal now, because if you check the items, 24,375, 12,843, 1125, 1270, 35,910, 13,850 and 29,390. Then we have 13,850, 29,390, and then we have 125 and then 240, and finally this closing stock. So it means if you have both the items, means both the sides, items in both the sides are equal, then I think total is going to be equal, and we can check it also. 5, 3 is going to be 8, then it is 7, 4, 2, 7, 5 to this 28, 2, and so it means both the sides are equal. It is 1,19,128 is the balance sheet. So you have seen the magic of the balance sheet, both the sides are equal. It means when both the sides are equal, you can understand that the balance sheet is balanced. This is a balanced document, and we have, means we can rest it assured that the firm is solvent. The firm is not bankrupt, firm is solvent. Firm has the proper account of all the sources from where the funds have been generated. They can be easily shown here. Now you see, we are generating resources here from this side, right, and first is the capital. It means it is a cash. It's similarly the sundry creditors, material they have supplied, we have converted the material into finished product. Finished product has gone to the market and we have sold that, and again that is converted into cash. Similarly advance, apprentice premium 400 rupees we have received in advance in the form of cash. So it means total cash we have received is, cash and kind we have received is 1,19,128. Now where this money has gone? This money has gone for the say we have purchased land and building for total is 25,000 rupees land and building we purchased, but to the extent of 625 we used the building and land this year, building particularly, and it has come down to 24,375 rupees worth. It means we have account, we can, if we sell this land and building in the market, we assume we will be able to recover for 24,375. Similarly plant and machinery, we have plant and machinery, we had the plant and machinery for 14,275, but out of that 10% we have depreciated, we have used, so it has, the value has gone down, depreciated 1427, so it has come down to 12,843. Then we have furniture and fixtures, we had 1250 worth of furniture, but out of that 10% we have used, 125 we have depreciated, so now we are left with 1125 worth of the furniture. Bills receivables, yes, I told you I will discuss with you the bills receivables. If you remember, I have discussed some time back also, but again I will discuss with you what are the bills receivables and what is the difference between the sundry debtors and bills receivables. Sundry debtors are almost, these are the similar kind of items. Sundry debtors are strictly those debtors of the firm who have to pay the firm at a later date, who have purchased goods and services or goods or services from the firm today. In the current period they have purchased the goods and services from the firm and they will be paying the firm back sometime later on. So these are the buyers of the firm's goods on say credit. So they are the sundry debtors. They are the sundry debtors. Bills receivables are also kind of the documents, means when we sell to them on credit. Now there has to be some documentary evidence. there has to be some documentary evidence that we have sold to somebody on credit and he will pay us in advance, he will pay us at some later date. Now, when we are selling to somebody and creating a bill, bill means is a legal document. It's written, is created by the company's lawyer or legal cell of the company on a judicial paper. Language remains written as that XYZ Limited has, for example, XYZ Limited company is the buyer from this company. So, XYZ Limited company has purchased goods worth rupees 1270 from Waterfalls Private Limited and they will pay us at the end of the credit period, means after 3 months or after 2 months, whatever the credit period is agreed between these two, that they will pay us, they will pay back an amount of 1270 at the end of 60 days or 90 days to the Waterfalls Private Limited, and because they have purchased the goods, right. So, this is written that they have purchased, we have sold, means the language remains that Waterfalls Private Limited has sold goods worth rupees 1270 to XYZ Limited and XYZ Limited has to pay a sum of 1270 back to the Waterfalls Private Limited after the means that date, maybe after 60 days or 90 days, that date has to be mentioned there and that document is written, properly sealed, and that is presented to the XYZ Limited's legal officials or the legal representatives. They will put their seal and signature, it means that document becomes valid. That firm has purchased and Waterfalls have sold. When they put their seal and signature, accept it, then it is returned back. One copy, photocopy they can keep with them, or one copy original also they can keep, they can prepare 2 copies. One copy the XYZ Limited will keep in their records and the one copy after signing they will return it back in original to the Waterfalls Private Limited. So, it is a documentary evidence that XYZ Limited has purchased goods worth rupees 1270 from this company and they have to pay them at the later date. So, that is called as the bills receivable for the company Waterfall Private Limited, and the other company who has purchased the goods and accepted the bill, it becomes the bills payable for them, and that bills payable will come on this side. If it is a bills payable, it will be a liability, and if it is a bill receivable, then it is a asset. Receivable means they have sold to other company, so they have to receive, it is a asset. They have purchased, so it means they have to pay at the later date, it is the liability. Clear? Now, these are the bills receivables. Then sometimes there are the bills which are called as accommodation bills also. Accommodation bills means where no real purchase of goods and services takes place. What happens that one company to help, financially helps for a short period, other company they create a document, say this company will create this bill that we have sold to XYZ Limited and XYZ Limited will pay us after 60 days or 90 days, right, but actually no purchase or sale has taken place, only help the company. So, what will happen, this company will, Waterfalls will go to the bank with this bill and they will show to the bank that look, we have sold the goods worth rupees 1270 to XYZ Limited. XYZ Limited is a very good company, financially they are highly credit worthy company. So, you please we need the funds immediately, they will pay us after 60 days. So, you purchase this bill, give us the funds immediately, and on the due date after 60 days when XYZ Limited will pay us, then we will return your funds. So, bank may, if the bank both the companies are good companies, credit worthy companies, then the bank may purchase this bill and bank will give them immediately 80% of 1270 and 20% they will pay on the settlement. When the 20% means when the funds will be paid by XYZ Limited, or maybe XYZ Limited will not pay, this Waterfalls Private Limited will go to the bank on the due date. They will say, okay, this 1270 is paid to us by XYZ Limited, they will generate the funds from their sources and this amount has come to us, please now you settle our account. So, you have paid us 80% of 1270, bank at that date will calculate the interest on that 80% plus the administrative charges, and if anything is left out of the remaining 20%, then the bank will further pay, and if nothing is left, then company will get only 80%, but the company got 80% 60 days in advance. and if some balance is left, then the bank will deduct its own interest on this 80% of this amount plus administrative charges, and then they will return the remaining amount, or the company will pay only to the bank the total amount, that is the interest on 80% of 1270 plus administrative charges, and after that they will not pay anything. So, it means immediately at least by accepting the bill by XYZ Limited for this company could get it discounted from the bank, and they could generate the short term funds for their short term immediate needs, otherwise this would not have been possible. So, if any bill is created, drawn and accepted by two parties on each other, then without any real sale of goods and services, then that bill is called as accommodation bill. Then we have say sundry debtors. Sundry debtors are those debtors where no bill is created, only on the basis of invoice. When no legal document is created, both the companies trust each other, but no legal document is created, then it is called as the sundry debtor, that they will buy the goods. XYZ Limited is buying goods on credit worth rupees 37,800, and invoice is being passed on to the buyer company along with the goods, and one copy of the invoice is kept, means they will give the receipt on the invoice itself. That invoice duly received by XYZ Limited will come back to the this Waterfalls Private Limited, they will keep it in record, they are called as sundry debtors. So, any sales, credit sales on which a proper judicial legal document is created, they are considered as bills receivables, and where no legal document is created, only on the basis of invoice purchase and sale takes place, then they are called as sundry debtors. So, part of the sundry debtors are doubtful, may not be recovered, so we should discount for that. Then other items are, if any of the total sources, if any of the part of the source is left not invested here, neither in the land nor in the buildings, plant, machinery, furniture, bills or credit sales, then it remains with the firm as a cash. So, this is the cash at bank 13,000, cash in hand 850, and these are the assets, means expenses paid in advance, that is fire insurance 125 paid in advance, rate and taxes paid in advance. So, this is the asset till due date, and similarly the closing stock which is there with the firm, and that will be sold at the later date. So, till it is sold in the market, it remains with the firm as an asset. So, we are showing it here as a closing stock. So, we have taken into account the total information, this and this, and now after adjusting everything given here, we have created three documents. One is the trading account, profit and loss account and balance sheet after adjustments, and then you see that the financial position of the firm is balanced, both the sides are balanced, they are equal, it means the firm's financial position is good, acceptable, the firm can be allowed to carry on the business. So, it means nothing to worry about. So, here I am taking a very simpler problem, but with the say passage of time in our next lectures, we will be moving towards the level of increasing the level of difficulty, and then once we discuss that the financial statements of sole proprietors, partnership firms and private limited companies, then we will move to the next step, that is the preparation of the financial statements of the public limited companies, which are little more complex as compared to these ones. That I will do in my next class. Thank you very much.